Confession. The pros don't agree, and that's the point. On Insibook today, we're cracking open how I invest my money to peek at real money diaries from advisors, planners, and thinkers. No single, perfect portfolio, just human goals, trade-offs, and the surprisingly personal reasons behind every choice. We'll speed-run story snapshots, college funds versus early retirement, cash comfort versus market risk, real estate versus index simplicity, and translate them into a few practical lenses you can steal. Purpose before products, risk you can sleep with, fees you can stomach, and a plan you'll actually keep when markets get loud. If you've ever felt guilty that your portfolio doesn't look like everyone else's, don't skip. This episode helps you build the right mix for your life. Grounded in values first, numbers second. Ready to design a portfolio that tells your story? Let's begin. Begin with the simple, unnerving question lurking beneath spreadsheets and market charts. If you woke up one morning with all your bills covered and your time truly your own, how would life look and feel? Every portfolio decision becomes easier when it serves that answer. Investing, then, is not only about maximizing returns, it's about constructing a life you recognize, one in which money funds comfort, curiosity, and contribution without stealing your attention. From that vantage point, asset classes, tax rules, and market cycles become tools in a toolbox rather than idols to worship or dragons to fear. What emerges from careful practitioners who handle money for a living and then turn the lens on themselves is far more human than a list of funds and tickers. It's a pattern. Start with values, translate those values into goals, and then reverse engineer a portfolio that makes those goals likely without demanding heroism. The process looks less like chasing the best possible outcome and more like choosing a set of good outcomes you can live with in peace. The target is not wealth for its own sake, but a feeling, security in storms, space to be present with family, the thrill of building something useful, the freedom to be generous. Once that feeling is defined, the money gets its marching orders. The first principle is simplicity in the service of behavior. Portfolios can be engineered to 10 decimal places, but the parts that actually move the needle are surprisingly plain. Save a meaningful percentage of income, automate contributions, diversify broadly, keep costs low, and hold steady through noise. Most who practice this craft for themselves build around broad index funds or total market funds, often paired with international exposure and a ballast of high-quality bonds or cash equivalents. The elegance lies not in exotic slices, but in how the mix matches time horizons and temperament. The guiding question is not, what could make the most money if everything goes perfectly, but what can I keep owning when things are not perfect? Risk, in this view, is not a number on a pie chart. It is the chance that money will fail the life it's meant to support. That's why the framework often begins with mapping time to buckets. One bucket covers the next few years of spending, insulating near-term commitments from the market's mood swings. The next bucket reaches further out and tolerates moderate volatility for better growth. The final bucket stretches decades ahead and embraces the full roller coaster of equities because the reward of compounding thrives on time. Each bucket has a job. The first keeps food on the table and sleep at night. The second sustains plans and obligations that can't be postponed. The third buys long-run freedom. During sell-offs, that first bucket is the buffer that prevents selling good assets at bad prices, and during ebullient runs, it's the reminder not to become overconfident. Behind those buckets sits a quieter but equally important distinction between the risk you can stomach and the risk you need to take. Some households have high savings rates, modest spending, and multiple income streams. They don't need a hair-on-fire portfolio to reach their goals. Others, starting later or burdened by commitments, may need more exposure to growth assets, even if that feels uncomfortable. The art is aligning risk capacity, what your finances can absorb, risk tolerance, what your emotions can bear, and risk need, what your goals require. When those three are coherent, discipline gets easier because every part of the plan is rowing in the same direction. A second principle is to locate risk in the right place. Most people already carry concentrated risk in the asset they ignore, themselves. Jobs, businesses, and careers are forms of human capital, and they are often highly correlated to certain sectors or regions. A tech worker living in a startup hub may carry a lot of implicit exposure to tech already. A small business owner may have most net worth tied to a single enterprise. Recognizing this, many balance their portfolios in the opposite direction. If career and business are concentrated, the investment accounts become diversified and conservative. If income is stable and bond-like, a pensioned career with predictable pay, there is more room to lean into equities. This reframing transforms the portfolio from a scoreboard into a counterweight. Cash, often dismissed as a drag in high-return scenarios, earns a central role here, not as an engine of growth, but as shock absorbers. The amount varies by household and season of life, yet the function is constant. Cash provides the ability to say no when life demands it. It allows a parent to take leave without rating investments, an entrepreneur to survive lean months, a retiree to ride out a downturn without selling shares at a discount. Some hold a year of expenses, others a few months. Others build tiered systems where a small cash pile is augmented by a short-term bond ladder. The precise number matters less than the commitment to keep that buffer intact and replenished. Debt decisions reveal the emotional architecture of money. Mathematically, it can make sense to carry a low-interest mortgage and invest the difference. Emotionally, many prefer a paid-off home for the psychic dividend of stability. The compromise one often sees is pragmatic. Capture the obvious returns first. Retirement matches, tax-advantaged space, diversified equity exposure, then channel surplus to accelerated mortgage payments if the household craves the security. With high-interest debt, there is no debate. It's a hair-on-fire emergency to extinguish so that compounding works for you and not against you. On the growth side of the ledger, the palette is familiar. Broad domestic equity, global or ex-domestic equity to avoid home bias, and bonds chosen for quality and purpose rather than yield chasing. Factor tilts toward small companies, value, quality, or profitability appear occasionally, but not as dogma. They're treated as incremental edges, not identity. Alternatives show up sparingly. Real estate may be present through a primary residence or a simple diversified real estate fund rather than leveraged speculation. Private deals appear only when expertise is genuine and stakes are limited. The recurring theme is humility about forecasting. If something requires precise timing or complicated narratives to work, it's probably not essential to a lasting plan. Fees receive unglamorous attention because they quietly compound in the wrong direction. Costs are treated as friction to remove low-expense funds, minimal turnover, and skepticism toward products that blend insurance and investing or promise stability with hidden complexity. Taxes are treated the same way. Asset location, placing tax-efficient funds in taxable accounts and tax-inefficient income streams in sheltered accounts, serves as a recurring habit. Where possible, new contributions and dividends are used to rebalance, limiting taxable events. Charitable giving is structured thoughtfully, not only for impact, but also for efficiency, using simple planning so that generosity and prudence reinforce each other. Implementation often defaults to automation. Contributions are designed to leave the checking account on schedule, not on whim. Rebalancing is triggered by wide bands or a calendar cadence, annual, semi-annual, rather than feelings about headlines. In practice, new dollars are funneled to whatever has fallen behind its target weight, and withdrawals in retirement are pulled first from the most overweight asset to gently nudge the portfolio back in line. The result is a system that nudges behavior forward even when life is busy or markets are noisy. Because investing is an emotional journey masquerading as a mathematical one, many build guardrails against their own impulses. Some set a small play account to scratch the itch of speculation while protecting the core. Others establish a waiting period between the desire to make a change and the execution, a cooling-off rule that spares them from chasing fads. Smartphone notifications are trimmed, financial news is skimmed rather than binged, and account checks are limited to predetermined windows. The message isn't austerity, it's attention management. The fewer decisions forced in the heat of the moment, the fewer mistakes compounded. Stage of life shapes the design. Early accumulators often accept more equity exposure and keep bonds minimal, knowing time is their ally and contributions will dwarf returns in the beginning. Parents with young children redirect some savings to education goals while maintaining retirement as the non-negotiable priority, understanding that borrowing is difficult for retirement but possible for schooling. Mid-career households, often with higher earnings but complex calendars, simplify portfolios aggressively to ensure they remain maintained. Fewer funds, clearer instructions, more automation. Near and in retirement, the emphasis shifts to sustainability and sequencing risk. The danger that a bad market early in retirement forces withdrawals from a shrinking base. To manage it, some elevate the bond allocation, others create a cash-plus short bond buffer for a few years of spending. Others adopt spending guardrails that adjust withdrawals slightly after strong or weak market years. The destination is the same, a portfolio unlikely to fail its owner even when life fails to cooperate. Insurance sits quietly behind the scenes, protecting the plan from risks that investment returns cannot repair. Term life covers the income that disappears if a provider dies prematurely. Disability insurance protects the asset most investors undervalue, the ability to earn. Liability coverage, built into auto and homeowner policies, and occasionally extended via an umbrella policy, shields net worth from rare but devastating events. Health coverage, while not an investment, enables every other choice. The through line is clean separation. Investing is for growth, insurance is for transfer of catastrophic risk. Blends and hybrids are eyed warily because they tend to be expensive ways to do two things poorly. Housing is treated not as an investment thesis, but as a lifestyle choice with financial side effects. The home anchors daily life and clustering of friends, family, and routine. The decision to buy or rent, to upgrade or stay put, reflects more than a spreadsheet. Still, sobriety prevails. Total housing costs, including taxes, maintenance, insurance, and commuting time, are kept compatible with long-term saving goals. Upgrades arrive thoughtfully, not to keep up with neighbors, but to increase daily satisfaction without stretching the plan thin. This restraint reduces the pressure on the portfolio to deliver miracles. Giving and legacy surface repeatedly, not as end-of-life footnotes, but as ongoing habits. Some siphon off a fixed percentage of income to causes and communities they care about. Others volunteer skills and time, recognizing that wealth includes attention and presence. Estate documents are kept current as an act of care rather than an exercise in control. For parents, the aspiration is not to script children's futures, but to equip them with literacy and values. An allowance that teaches trade-offs, a savings jar that introduces delayed gratification, a small investment account that makes abstract concepts like compounding visible, and honest talk about choices the family makes and why. What ties these stories together is the idea of enough. Enough is not a number, it's a boundary. It marks the line beyond which additional wealth fails to buy correspondingly meaningful increases in life satisfaction and may even subtract by encouraging overwork, anxiety, or keeping score. When enough is defined, money stops being a referendum on identity. Ambition remains, but it becomes selective. The portfolio reflects this restraint. No need to swing for the fences when a clean single to the outfield scores the run. Crises reveal whether a plan is real. In the fever of market crashes or the fog of a sudden job loss, the system either protects you or betrays you. The approach here is to assume storms will arrive and to decide in calm how to behave in chaos. That means anchoring to the buckets, ensuring that near-term spending is insulated, and reminding yourself that volatility is the price of admission for long-term growth. During upswings, humility prevents extrapolation. During downswings, perspective prevents despair. A written statement, why each holding exists, the conditions under which it would be sold, the rebalancing process, is a quiet ally. When fear spikes, you reread your own logic rather than outsource decisions to headlines. Diversification across borders checks the natural urge to bet one's future on familiar ground. Home country bias is cushioned by global equity exposure. The exact slice varies. Some prefer a total world fund. Others tilt toward domestic markets while maintaining a meaningful allocation abroad. But the principle is shared. Spread bets so that any single economy's political risk, currency risk, or valuation extremes don't dictate your outcome. Bonds lean high quality and short to intermediate in duration when used as ballast, because their job is to hold up when stocks fall, not to entertain with yield in the sunshine and abandon you in the storm. For those with illiquid assets, private businesses, real estate partnerships, concentrated stock grants, liquidity management becomes its own craft. A higher cash reserve, a conservative bond sleeve, and a commitment to avoid borrowing against volatile collateral are the norm. Proceeds from occasional liquidity events are dripped into diversified markets rather than thrown in at once, acknowledging that fortune and timing are unreliable partners. The aim is simple. Don't let the exciting part of your financial life, the business, the project, the art, force reckless decisions in the quiet, compounding part, the portfolio. Spending itself is curated as carefully as investing. Instead of mindless leakage, subscriptions left to auto-renew, upgrades made from boredom, spending is gathered into a handful of priorities that actually produce joy or meaning. Travel that deepens relationships, experiences that create memories, tools that elevate craft, generosity that aligns with personal narrative. These receive green lights. By contrast, status purchases and hedonic treadmill upgrades are recognized for what they are and politely declined. This editing process is not asceticism. It's art direction for a life. Many keep a conscious separation between serious money and fun money. The serious funds live in custodians, quietly compounding with minimal intervention. The fun money, small by design, allows for curiosity. A speculative stock here, a quirky idea there, a new platform or trend explored with pocket change. This separation channels energy without jeopardizing goals, satisfying the psychological need to experiment while cordoning off risk. The practice acknowledges a truth. Humans are not spreadsheets, and a plan that ignores human texture invites rebellion. Retirement is reframed from a cliff to a gradient. Few imagine ceasing all paid work on an arbitrary birthday. Many imagine shifting into projects of choice, part-time roles, teaching, advising, or entrepreneurial stints. The portfolio supports this flexibility by not requiring rigid withdrawal rates. Guardrails guide spending. If markets deliver strong returns, a raise is justifiable. If markets struggle, a modest tightening keeps the base intact. Social income, pensions, government benefits, annuitized streams constitutes a floor, while investment accounts provide the upside. This two-layer system reduces anxiety because it decouples necessities from market weather. A thread of self-forgiveness runs through deliberate portfolios. Everyone who invests long enough makes mistakes. Buying too much of a darling, selling too early in a rally, waiting too long to deploy cash. The response isn't to pretend omniscience next time, but to build structures that make future errors less costly. Diversification, position sizing, contribution discipline, and precise definitions of why each asset exists serve as error dampeners. Progress, not perfection, becomes the scorecard. Even with all the rational structure, beauty remains a legitimate criterion. Beauty appears as unhurried mornings with kids, quiet walks with a partner, the Saturday ritual of coffee and notebooks, the volunteer shift that makes you feel useful, the sabbatical that rekindles a skill. Portfolios are shaped to make this beauty durable. Enough liquidity to seize a moment, enough stability to endure shocks, enough growth to expand choices over time. Money stops auditioning for attention and starts performing its role in the background. In practice, the architecture can look like a handful of funds representing the global stock and bond markets, tuned to a target mix and held across accounts with attention to tax placement. Contributions flow automatically from paychecks to pre-tax, Roth, or taxable accounts based on current and expected future tax brackets. Rebalancing occurs twice a year or when allocation drifts beyond bands, using new cash first. Cash for emergencies sits in a high-yield savings account or a ladder of short-term instruments. Insurance is reviewed annually. Estate documents are refreshed after major life events. The entire system is legible on one page, which is the point. Clarity breeds adherence. What's notably absent are precise forecasts. Calendar pages don't contain dates circled with recession or top. Instead, there's a standing assumption that the future will contain both bruising downturns and generous advances, with neither arriving on a schedule. This humility keeps the plan anti-fragile. It does not depend on guessing. It depends on enduring. The goal is to be alive and solvent on the other side of whatever comes, so that compounding can resume its quiet work. Time itself becomes the superstar asset. Early small contributions matter enormously because they invite compounding to an extra decade of rehearsal. Later, larger contributions matter too, but they cannot wholly substitute for time. The practical consequence is to begin where you are, with what you have, and to let shame about late starts or envy about early starts go. The slope of the line forward is the only part you can control, and the slope steepens dramatically when rising income is captured through automatic increases to saving rather than evaporating into lifestyle inflation. The community rounds out the design. Money becomes more resilient when shared language exists within a household. Couples converse openly about what money means to each of them, where fears live, what their freedom number represents, and how they will respond to market storms. Children are looped in at age-appropriate levels, not to burden them with adult worries, but to demystify the machinery. Friends and mentors offer sanity checks and keep each other from overreacting. The portfolio is personal, but no one is truly alone in building and defending it. From the outside, a plain vanilla, diversified, low-cost portfolio paired with consistent saving can look unambitious. From the inside, it is profoundly ambitious because it attempts something hard, enduring boredom, resisting extremes, and aligning daily actions with long-term meaning. The ambition shows up not as fireworks on a performance chart, but as weekends protected from fear, dinners paid for without guilt, and work chosen for joy rather than survival. In that light, the plan ceases to be a compromise and becomes a quiet rebellion against a culture that monetizes attention and anxiety. The most surprising discovery in candid financial diaries is how varied right can look. One person keeps an oversized cash position because their business swings with the seasons. Another keeps none because both partners have tenured careers and predictable income. One treats a paid-off home as a fortress. Another carries a mortgage comfortably because the math checks out and flexibility matters more. One loves the simplicity of a single fund that owns the world. Another adds a small tilt toward factors they believe will reward patience. All of them, however, share the same spine: explicit goals, humble assumptions, low costs, and behaviors designed to endure. If there's a single sentence that captures the through line, it's this: build a portfolio that lets you look away. Not because you are indifferent, but because your attention is too valuable to spend on every market twitch. Glance intentionally, act on a schedule, live meanwhile. Money becomes a component of a coherent life rather than a constant referendum on whether you are doing it right. Eventually, after months and years of contributions, rebalances, and ordinary days, the numbers begin to tell a different story back to you. The emergency fund that once felt fragile now looks redundant because your baseline stability is stronger. The investment accounts cross thresholds that once felt mythical, and the idea of stepping back from paid work or taking a risk no longer feels reckless. Generosity scales. Anxiety recedes without disappearing because you've learned that nerves and discipline can coexist. What completes the picture is not a final net worth figure, but a feeling of funded contentment, the sense that life is largely underwritten, that you can plan in seasons rather than paychecks, and that you have the agency to say yes and no for reasons other than fear. So, the craft of investing one's own money, when practiced with candor and care, resolves into a mosaic of small, durable choices. Decide what matters. Ensure short-term needs are untouchable. Own productive assets for the long run. Let bonds and cash do their quiet work. Pay little for the privilege of participating. Use taxes and insurance as servants, not masters. Automate what should happen anyway. Write down rules in calm and follow them in thunder. Spend on what makes days vivid and relationships deep. Teach the next set of hands what these choices mean. Redefine wealth from more to enough, and let the difference buy you time. There is nothing mystical about this, and that's the liberation. The path does not require rare genius or uninterrupted bravery. It asks for a few plain habits and the patience to carry them across years. Markets will cooperate and sometimes won't. Headlines will praise and then scold your allocation without knowing anything about your life. Friends will get rich quickly on things you don't understand. You will make choices you later wish you hadn't. None of this invalidates the work. In fact, it's the ordinary texture of the journey. If you were to start today, you could do so with surprising humility and power. Sketch the life you want in specifics: time, place, people. Tally what that life truly costs. Build a buffer so that small shocks do not become big crises. Choose a simple portfolio that makes sense to you even after a hard month. Automate contribution and rebalancing. Clean up debt that taxes your future. Accept that the plan will be boring in between the milestones. And then, most importantly, go live the life you designed, because a plan without a life attached to it is just a clever way to procrastinate. Money, invested this way, becomes a gentle river that powers the mills you care about. family, craft, curiosity, service, without demanding that you stare at the water every hour. Some days it rushes, some days it runs low, but it keeps moving forward because you built the banks with foresight. That is the quiet confidence of people who invest their own money with purpose. They aren't praying for a miracle. They are building a system. And each day, that system buys back a little more of their time until one morning they notice that the markets can do what they will, and they will still do what they came here to do.